Today, we will talk about beta, definition, calculation, and explanation for investors. Beta is a measure of the volatility, or systematic risk, of a security or portfolio compared to the market as a whole, usually the S&P 500. Stocks with betas higher than 1.0 can be interpreted as more volatile than the S&P 500. A beta coefficient can measure the volatility of an individual stock compared to the systematic risk of the entire market. Beta effectively describes the activity of a security's returns as it responds to swings in the market. A security's beta is calculated by dividing the product of the covariance of the security's returns and the market's returns by the variance of the market's returns over a specified period. The beta coefficient is calculated using the formula beta coefficient equals covariance, R_E, R_M, / variance, R_M, where R_E is the return on an individual stock, R_M is the return on the overall market. Covariance is how changes in a stock's returns are related to changes in the market's returns, and variance is how far the market's data points spread out from their average value. An investor uses beta to gauge how much risk a stock is adding to a portfolio. Beta provides insights into how volatile a stock is relative to the rest of the market. The market used as a benchmark should be related to the stock for beta to provide any useful insight. A stock with a beta of 1.0 indicates that its price activity is strongly correlated with the market. It has systematic risk, but the beta calculation can't detect any unsystematic risk. A beta less than 1.0 means that the security is theoretically less volatile than the market, making the portfolio less risky than it would be without the stock. A beta greater than 1.0 indicates that the security's price is theoretically more volatile than the market, increasing the portfolio's risk and expected return. Some stocks have negative betas. A beta of -1.0 means that the stock is inversely correlated to the market benchmark on a 1:1 basis. The beta coefficient theory assumes that stock returns are normally distributed from a statistical perspective. However, financial markets are prone to large surprises, and returns aren't always normally distributed. This means that what a stock's beta might predict about its future movement isn't always true. While beta can offer some useful information when evaluating a stock, it does have limitations. Beta is useful for short-term risk evaluation but becomes less meaningful for predicting a stock's future movements. It is also less useful for long-term investments. A good beta depends on your risk tolerance and goals. A beta of 1.0 replicates the broader market, while a lower beta may be more appropriate for conservative investors. Betas greater than 1.0 tend to produce above-average returns in a bull market but also produce larger losses in a down market. While beta provides information about risk, it is not an effective measure of risk on its own. Beta does not provide forward guidance or consider the fundamentals of a company or its earnings and growth potential. A beta of 1.0 for a stock means that it has been just as volatile as the broader market, while betas larger than 1.0 indicate greater volatility, and betas less than 1.0 indicate less volatility. Here are 3 key takeaways. 1. Beta measures the volatility of a security or portfolio compared to the market as a whole. 2. A good beta depends on risk tolerance and goals, and beta is not an effective measure of risk on its own. 3. Betas greater than 1 will tend to move with more momentum than the S&P 500, stocks with betas less than 1 with less momentum. Hope this would help. Thanks for watching.